Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Today, on deck, we have episode number 12, How Buyer Confidence is Really Built. And this really defines your maximum multiple, because buyers don't pay more because they like your business. They pay more when they trust it. They pay more when they know that magic is going to happen after the purchase, whether it's a platform company, whether it's part of a roll-up strategy, where they're buying up entire areas. What they want to know is, at the end of the day, can we repeat business? So we got to talk about the difference between confidence and optimism. Optimism is a belief. Confidence is evidence. Sellers, they often tell stories, and buyers, they pay for proof. What you're going to want to know is, the more history that you can prove, the higher the chance of you getting your maximum multiple. And if you can have really good notes, if you can have detailed notes, not all of your employees have to see them, not all of your management has to see them, but if you're maintaining records, it works to your advantage, because then you have certainty, but you also have proof. Confidence is the buyer's feeling that outcomes are repeatable, that they can happen again. They weren't just a fluke, and that the risks when they make a purchase are all understood. And you're going to find that it reduces discounting, holdbacks, and just-in-case deal terms. These are all things that you may or may not see. And in all companies, all investors, all private equity firms, they'll give you an option. They're like, we'll give you all cash right now, or we're going to give you some holdback terms. Or they may come in and just say, here's what we're going to do. We're going to do an 80-20 or a 90-10. You give you 80% of your money up front and hold back 20% for 1 year or 2 years. Or we're going to give you 90% of your money and we'll hold back 10% for 1 year or 2 years. And then all of these little mistakes, all these little errors are places where they come in and say, hey, we got to pull back some of this money. It's not what you said that it was going to be. That we don't have, you said that there was proof. The proof is a good running company, and it's just not there. Your buyers, they want consistent financials, operational metrics, client retention data, documented processes, and if it's not measurable or documented, it's treated as uncertainty. And every time there's uncertainty, it costs you money, which is your money. You should get every cent that you can out of an exit. It shouldn't be to questions. You know, if the standard multiple in your industry is 3 and you're shooting for 5 times profitability, then it's going to take proof. I mean, even if you were shooting for 15 and you wanted 20, it's going to take documented proof, and it's going to take history. This is why, when it comes down to it, preparing for an exit can take 5, 4, 3, 2 years. Sometimes people are like, hey, can we do it in 18 months? You can absolutely do it, but you're probably going to leave some money on the table, and it's your money. And if you can stick in an extra 18 months, 12 months, sometimes the value that you're going to get for your multiple is just beyond what you could guess. There's going to be a track record validation. The buyer, they're checking your patterns. They've got statistical ways for them to dump information into a computer, and then with AI and all the technology that's out there today and all the purchases that have made, it'll give you a risk tolerance. It'll give you a ratio. It'll give them a ratio, and it'll say, hey, is this a good company or not? And if it's not, it'll start saying, hey, there's some warning signs. There's some flags that we need to pay attention to here. There's some problems that we need to take a look at. So they're going to take a look at your history, your growth trends, your margin stability, churn, pipeline conversions. They're looking for a consistent growth over time, not just peaks. They want to know, hey, can you duplicate this magic again? And can you duplicate it again in a way without you being there, and that it's going to improve every time? They know that a hot streak can be luck. Repeatable execution is capability, and that's what they want. The buyers, they're going to test if it survives changes in people and timing and market conditions. They want to know in the ups and downs, were you able to make Profits. Were you able to have consistent projects and people working for you? So they look for systems maturity and signals, confidence accelerators. This is going to come down to process documentation, standard operating procedures, KPIs, key performance indicators, cadence. Do you have meetings consistently? Role clarity. Are there job descriptions? Is there an org chart that people follow? Is there decision rights? The decision rights could be hiring, they could be firing, they could be purchase decisions, they could be investment decisions, they can be changes inside of a department. Ultimately, at the end of the day, what they don't want is founder having to make all the decisions or the owner having to make all the decisions. Systems make the business feel ownable by somebody else. Can we turn this organization over to somebody else? The transparency in the reporting and the history reduces fear. You want clean reporting. You want clean explanations and fast answers. Slow, defensive, inconsistent responses create some suspicion, even if there's nothing wrong. I've looked at deals and we said, okay, hey, look, here's what we need is we need the last 3 years financials and profit and loss statements. And sometimes people like, I don't know where those are. Okay, well, you are selling a business, or we're behind and we haven't got caught up. Like, that's okay. Well, if that's true, what else is wrong? You start asking questions as an investor. Where is this not being taken care of the right way? And message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. If you really want a forecast multiplier, it's confidence. Buyers, investors love to see companies that can predict revenue, manage pipelines, and explain variance. Hey, we know what happened. We know what went down. We tried a new product or service. We had some issues. We were able to recover. We were able to make some changes. The tough answer is, I don't know. We didn't consider that. We didn't know. We've never looked at that before. Those are all questionable answers to some of the forecast. You want the buyer to perceive, like, is there a lot of risk here, or is there not a lot of risk here? If you're taking a look at due diligence and you can produce the documents quickly, reconcile cleanly, answer information consistently, diligence becomes smoother, and smoother due diligence correlates with better terms. It looks better on your end. If you can signal, hey, listen, everything is good here, and you can prove it and back it up with facts, you're on the path for the maximum multiple. I can't say you're going to get the maximum multiple, but you're definitely on the path. When a company is sold, one of the questions that is asked over and over and over again is, who do you think is going to stay and who do you think is going to go? Because companies, you don't want to have to recreate an entire company. You don't want to have to recreate an entire division. There's going to be people who leave. There are going to be people who say, I don't want to go work for somebody else. I don't want to be a part of an organization. But there's a predictability. If somebody says, hey, I've got 10 employees, will 9 of them stay? Will 8 of them stay? Will 7 of them stay? Because the last thing an investor wants is to take over a company and have everybody walk. That's not a good position. Can the company run without the founder? Is the culture good? Is it personality based? Does stability happen? Because when you integrate and you bring in another company or you bring in another team, you don't want to run the risk of people leaving. As you take a look at how due diligence is done, confidence is really built in the small proofs. Examples come from like a monthly closeout date, discipline, KPI reviews, documented onboarding, client success playbooks. Each proof says, hey, we can run this company without heroics. We can run this company without people getting in the way. We can make magic happen whether we have to rough a storm or not. That is what investors and private equity and business buyers want to see. When you're taking a look and you're saying, okay, I'm going to sell my company and there's 5 people that I want to sell to, confidence expands your buyer pool. There's more people. The less risky that you appear, the more that people can justify paying a higher multiple. Private equity, family offices, private investors. You want competition. You want people salivating over you. You want that maximum multiple. You want the bragging rights. You want the money. Competition increases the price. There are times where I have seen people say, hey, listen, I really want to sell to you, but I've got a better offer. And sometimes if that company is desired, they'll match it. I'm not saying all the time. It is a play out of the playbook. Confidence changes the structure, the deal structure, not just price. High confidence in repeatability changes earnouts, holdbacks, simplifies reps and warranties or baskets. The goal can't just be a higher multiple. It's got to be a cleaner, less risky deal for the buyer and for the seller. And all these things ultimately work towards your favor. You can engineer buyers' confidence. You can absolutely do this. You want to start with financial clarity. You want operational documentation. You want leadership depth. You want predictable revenue signals. And then each one of these stages, they reduce the unknowns and they pull back the discounts that you may get. So pick one of the confidence gaps: forecast reporting, documentation, leadership coverage, and turn it into a measurable coverage for the next 30 days. Confidence compounds when buyers can verify and not just hear. These tests that you run and these strategies that you pull where you say, hey, the team has got to pull their weight and we're going to validate information, makes all the difference in the world. And when you start getting a team on a cadence and you're running a test monthly, quarterly, what ends up happening is it reduces the reliance upon you. It increases your quality of earnings. It increases your quality scoring from the private equity company, the investor, the buyer who may be coming in. I can't give you 100% certainty and say, hey, here's exactly what's going to happen. I can say with certainty that there are a lot of companies that are willing to pay a lot more if you can show them proof. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.